Over the last few years, most investors haven't made money because they were diversified or because they picked great stocks. In reality, a handful of companies did the heavy lifting. And when returns come from such a small group, it quietly changes how your investments behave, especially when you're forced to make a decision. So what's actually going on? So over the past few years, 7 companies have become a huge part of the S&P 500. And as of about December 2025, where we are now, these 7 companies, so you've got Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla, are worth roughly 21 trillion USD combined. So that's about 1/3 of the entire S&P 500's total market cap is coming from just 7 stocks. In other words, 7 companies out of 500 now represent more than 1/3 of the index. And a big reason for this is the AI narrative pulling capital into these 7 companies. If you think about it, most of these 7, even though they're slightly different, you've got tech companies, car companies, graphic card companies, they're all focusing on AI and all have a heavy reliance on AI. But this isn't really a video about AI or the Magnificent Seven. It's about what happens to your investments when a single story gets big enough to quietly concentrate risk. When 7 companies drive that much of the market, then small moves and a few stocks start to have a huge outsized impact on your investment returns. So if you were perfectly diversified across 500 companies of the S&P 500, and there were a few bad apples, they would get diluted across the 500. But when the concentration in just 7 is so high, that means one bad move from one of those 7, or even a couple of the 7, has a huge impact across the whole index. So it doesn't mean your diversification is gone or that you're not diversified. It just means that it becomes really less forgiving when something goes wrong. But it also has an outsized impact when something in the Mag 7 goes right. But overall, your investment portfolios behave very different when outcomes depend on just a few names. The last time a new technology concentrated markets like this was during the dot-com boom in the late 90s and early 2000s. Not because investors were wrong on the technology. Anyone now knows the internet was a big deal. You could take any Muppet off the street, send them back in time 25 years, and they would tell everyone they know that the internet's going to be a big deal. So investors weren't wrong about the technology, but their expectations of what it was going to deliver were way ahead of reality. So many companies had no durable business model other than slapping a .com on the end of their name, and many of them had no clear path on how to make a profit, which is kind of important for a business. And during that time, investors made 2 huge mistakes. The first one was that assuming most of the companies tied to the internet were going to win. And the second issue was concentrating their exposure around that outcome. So getting heavily invested in internet-related companies. So the biggest losses didn't come from being wrong about the internet. They came from assuming everything tied to the internet would work and then building portfolios around that assumption. Now I want to be careful here because this isn't coming from headlines. I'm a software engineer and I spend my time building products and working inside real investor portfolios, and I use AI every single day. So tools you're familiar with like ChatGPT or Claude, I'm right in there as well using those tools. And even more so, I'm using tools like Claude Code, which help me produce software. And the crazy thing is at the moment, I feel like I am coding at the same level as 2 or 3 developers, whereas over the last 10 years of my career, I was just coding as myself. And even then, as myself, I'm doing all the boring little bits that a developer has to do, whereas now I don't have to worry about that part. Not only am I heavily using AI, but I'm also building AI into the products that I create. So inside Navexa, for example, a lot of our customer support is handled by an extremely powerful AI agent that can answer questions. We've also built AI into the product itself, so you can talk to your portfolio and say things like, if I sold my Apple shares for $1,000 today, what would my tax liability be? So those uses of AI, along with business analysis and intelligence work that I'm doing, from things like marketing strategy through to sales, through to product development, I am personally leveraging AI all throughout my life on business side and the personal side. But interestingly, I'm already seeing AI companies and AI startups failing to deliver on what their original promise is. And that's not because AI is useless. We know that it's extremely powerful, but because building a company that has reliability, scalability and defensibility is really difficult. So it's really easy now to whip up a piece of software using one of those AI companies that produce software from a single prompt. And there's numerous stories of these online of people building an MVP, launching the product, and it gets customers and starts working. But as soon as too many customers log on, crashes. Or as soon as they want to change the software, they can't change it because AI kind of wrecked it the first time. And that means it's not reliable, it's not scalable. But then defensibility becomes a huge problem. And this is a question I have to ask myself all the time running a tech company, is how do we defend when competitors can just pop up and recreate the software extremely quickly? So the thing is, AI makes people productive extremely quickly, but turning that into a reliable, defensible business is a much harder thing to do. Now, this is where the gap between what AI can do and what companies can reliably turn into a business starts to matter for investors. So we know the AI capability is real, but capability does not equal reliable business outcome. So translating AI into repeatable revenue, a durable advantage, long-term margins is really difficult. So even if AI wins in the long run, it doesn't mean everyone in the AI space is going to win. And when these outcomes are uncertain, then concentration matters even more. And this is where this stops being an AI conversation and becomes a your portfolio conversation. Because all of this only matters when it shows up in real portfolios and forces real decisions. So these usually show up in portfolios in three ways. And the first issue is concentration that people don't actively choose. So it's really common when people buy an ETF for the S&P 500, for example. It feels like you have diversification, and in many ways you do. You're invested in the whole index. But when returns are increasingly driven by those top 7 companies, exposure starts to build without your actual intent. You didn't choose to get exposed to the tech AI sector, but in investing in the S&P 500, you have the illusion you're diversified, even though you are now heavily tied to the tech sector. The other part is all the remaining companies, many of them are going to be dependent or built on top of those 7 companies, and that puts all of those ones at risk, as well as the top 7 being at risk. The second problem is the silent tax buildup. So this issue doesn't feel like a risk or a problem until the moment that it does. And what I mean by that is over long bull markets, so we've had all-time highs now going for quite a while, this builds up a large unrealized capital gains tax liability. Now that sounds really boring, but what it means is because the gains are getting so high, when you go to sell, you now have a huge tax liability. And this becomes extremely relevant when markets have moved in such a way that triggers you to rebalance your portfolio, for example. If you're suddenly really overweight in your tech sector, your strategy might be to sell off a bunch of that so you can distribute it again into different areas. Also, if you need to raise cash for something, maybe you need to buy a car or buy a house, or you want to invest in something else, you need to sell those investments to pay for it, and that triggers a big CGT event. And then the most common one, which is very unfortunate, is panic selling. When things start tipping over the edge, panic selling kicks in, people start executing sell trades without thinking about it, and they usually discover the problem right after they've sold something. The third problem is currency. So currency amplifies the volatility. Many investors invested in US markets are not based inside the US. So for example, myself based in Australia, when I buy into a US stock or a US index in this case, I'm also exposing myself to the exchange rate between the Australian dollar and the US dollar. And it wasn't that long ago, about 12 or 13 years ago, where the US and Australian dollar was 1 for 1. And now it's somewhere around 60-ish cents last time I checked. So it's like a 35 to 40% swing in currency. And Australian investors and investors all around the world always underestimate the foreign exchange impact. And the turbulence in that concentrated Mag 7 then magnifies the currency moves even more inside your portfolio. Most brokers don't even show this at all, and often people think they're reacting to markets, but sometimes they're just reacting to the currency movement themselves. So the overarching issue is that most investors don't actually realize how exposed they are until a decision like one of those forces them to find out. The real tipping point, and I mean when people talk about a tipping point, they usually mean a market event, but that's not what I'm talking about here. A tipping point isn't a crash, it's the moment you are forced into making a decision. And that's usually triggered by rebalancing, or market volatility means you have to make a move due to your strategy, or life events. There might be a wedding or a funeral or buying a house or buying a car. Any number of things force you into selling something. And that's when people actually realize they don't know where their returns came from, how concentrated you are, or what selling will cost. And the worst time to discover your real exposure is the moment you're forced to act. Now, when you zoom out, it's usually not markets that damage portfolios. It's the decisions people have to make under pressure. And bad decisions come from incomplete data, misleading performance numbers, and no tax context. So if you don't have your full trade history available, or if you're not tracking performance correctly, so looking at things like capital gain, income return, currency return, and annualized total return, you have no idea what your performance is actually doing. And the one that is so common is the no tax context. So most people, when they execute a sell trade, have no idea what the tax liability is going to be. And that is not okay. That means you're investing in the dark and you don't know what you're doing. You need to know what it's going to cost you before you click sell so you can make a smart decision. But it's not that people are reckless, and if you've done what I've described, I usually find it's not because you're reckless. If anything, people are usually over conservative when they're investing. The issue is that they're underinformed. So when the data is wrong or incomplete, even a reasonable decision can turn into a bad one. Now, if there's one pattern behind all of this, it's that serious investors don't wait until the last minute to understand their numbers. Serious investors are tracking their true performance. So like I said before, the capital gains, your income return, your currency, your annualized return. You're looking at unrealized gains. So knowing how much of your current position is an unrealized gain or loss, and knowing their tax before acting. And this is how professional investors and high performance investors operate on a daily basis. And it's also where most broker platforms fall short. And that's the gap that Navexa exists to fill. If you're interested, check the link in the bio, give it a try for yourself. So AI may change everything, and it may also disappoint in ways people don't expect. And the thing is, you can't control how the technology is going to play out. You don't know which companies are going to win and which ones are going to collapse. But what you can control is whether you actually understand your own portfolio. So where does your concentration risk lie? What's your actual performance figures, and what are your tax figures, so that you can make confident decisions as soon as you need to, rather than being forced into making a decision and having no idea. So AI likely will change everything, but it will disappoint people as well in ways that we can't expect. And the thing is, you can't control how the technology plays out. We don't know where AI is going to be. I don't know what kind of job to recommend to my 3 boys in 15 years is going to be. And we also can't control which companies are going to win. Is it going to be OpenAI? Is it Anthropic? Or is Google just going to winner-takes-all situation yet again? What you can control is whether you actually understand your own portfolio. Do you know where your concentration risk is? Do you know how you're diversified? And can you tell me your true performance figures? Do you know your capital gain, your income return, your currency return, your annualized return? These things are critical, and they're all within your control. These are especially important to know before the market moves and forces you into making a decision.